Fear sells more than facts every single time. Every time the markets shake, you see headlines screaming, the 4% rule is dead, retirement dreams are crashing, etc. Now, whether you're saving for your retirement or planning when you can stop working, these headlines can be terrifying. But here's the truth. The media always thrives on drama because fear gets the clicks, calm doesn't. In our last video, we talked about how living richly is more important than being rich. Now, today we are asking the $1,000,000 question. What is your enough number? And is the 4% rule, which is used as a gold standard in retirement planning, actually dead? Let's take a step back and get a quick refresher. In the 1990s, a financial planner named Bill Bengen looked at US stock and bond market data going back to the 1920s. He wanted to answer the one critical question. What is your safe withdrawal rate? Which means, how much can you pull out from your retirement portfolio every single year without running out of money? His answer was 4%, which means if you withdrew 4% of your starting portfolio every year, adjusted it for inflation, and invested it in a 50-50 split of stocks and bonds, then your money would last 30 years, even through the Great Depression and even through the inflation crisis of the 1970s. Later, the Trinity Study in 1998 confirmed this. They ran thousands of simulations across 30-year rolling periods and found out a success rate of approximately 96%. So in theory, if the markets give you an inflation-adjusted return of over 4%, then your initial pot will not run out forever. But what do you feel? Comment below. Does the 4% seem like a safe percentage for you, or does it seem terrifyingly high? Now let's fast forward to the present. Recent research by RBC Wealth and Morningstar argue that the number might be different now. Lower bond yields, higher stock valuations, and longer retirements mean the safe rate may actually be closer to 3 to 3.5% today. But here's the thing. If your 4% rule survived the worst of the 20th century, should we really believe that it's suddenly dead because the media says so? Or is there more nuance to it? Let's look at the evidence. Over the last 100 years, the stock market has averaged about 10% returns before inflation. But the smooth line hides the chaos that happened beneath. Markets do crash. The Great Depression of 1929 is a great example where we saw Dow Jones fall by over 80%. Recovery took over 25 years, but it wasn't just a market crash. It was a perfect storm with banks failing with no deposit insurance, global trade collapsing because of devastating tariffs, and deflation spiraling, destroying business profits. What's more, the World War II disrupted everything. So could that happen again? Well, in theory, yes, because geopolitics can be messy at the best of times. But equally, we have much more stronger frameworks and safeguards today. We have central banks that provide liquidity, we have deposit insurance, and we have global cooperation frameworks like the International Monetary Fund, etc. Now, here's where it gets interesting. Let's look at the more recent crashes. The dot-com bubble of 2000. It was a 49% drop and roughly took 7 years for recovery. The 2008 financial crisis, markets fell by over 50%, could have been another Great Depression, but markets recovered in 6 years. And more recently, the COVID slump of 35% in 2020, and markets rebounded in a record period of 6 months. Can you notice the pattern here? That recoveries are getting quicker and more efficient. So here's what this teaches us. Big crashes are usually linked with wars or systemic failures. It requires longer recoveries. It is rare, but still possible. Financial crashes, on the other hand, have shorter recovery periods. It can be painful during the time it lasts, but survivable if you don't panic for 4 or 5 years. Regular 10 to 15% corrections are normal. They are usually just the noise created by media, and they can recover in months. But here's the critical point most people miss. The stage of life you're at matters more than the magnitude of the crash itself. So if you're in your 20s, 30s, or even in your 40s, downturns can be great opportunities. But if you're at or closer to retirement, you can't afford to sell at the bottom, which is why you need to have the buffer of safe investments like cash, bond, fixed deposits, etc. This is where most of the financial advisors stop. But let's go one step deeper. The 4% rule actually assumes a 50-50 split in stocks to bonds in your portfolio. But most of us don't invest that way our whole lives, do we? Retirement planning actually has to be done in phases. You have your growth phases in your 20s, 30s, and 40s, where you can go heavy on equities. Volatility is fine because time is on the side. Bonds matter less because you're focused on compounding. Next, you come to your consolidation phase in your 50s and 60s. You start balancing, you lock in your gains, and reduce your risk. Bonds, real estate, and cash can start playing major roles here. And finally, you have your drawdown phase, is when you're actually retired. This is your preservation mode. Here's where the sequence of returns risk, which is just a fancy term for bad timing, becomes your enemy. A crash very early in your retirement can hurt way more than a crash later, which is why you need to keep part of your money safe so that you never have to sell your stocks when they are down. The 4% rule was designed for this balanced approach. So no, you don't need 50% of bonds when you're 30. But as you near your retirement, balancing growth and safety becomes essential. And the 4% rule still works, provided you use it appropriately for the stage of your life that you're in. Another very important point that these financial studies don't talk about enough is that real life is flexible. And flexibility is what makes it beautiful and make your money last longer. You can geo-arbitrage. That means you can consider retiring or spending part of your retirement in India, Portugal, or Thailand. This can stretch the same dollars much further than it does in New York or London. You can do part-time passion work. Even by earning a small income doing what you love makes a huge difference to your retirement portfolio. And then you can remain flexible in your expenses. When your markets dip, there is no shame in tightening your belt a little. It helps your portfolio recover faster. But I know what you're thinking, my friends. What if you cannot be flexible? Fair point. But here's the thing. Flexibility isn't just about cutting your expenses. It's about having options. And it's these options which give you power over your financial future as well as control over your life as well. Flexibility is the secret sauce that financial studies cannot model, but real life always demands. So how do you actually calculate your enough number? Here's a simple framework. Take your annual spending needs, times it by 25. That gives you your enough number. The inverse of 25 is 4%, and that's where the 4% rule is truly in action. But then, when you get your enough number, customize it, adjust it for your location, see if you have any healthcare costs, family support, local inflation, layer in your safety nets such as the rental income, pensions, side hustles, and this can actually reduce what your portfolio needs to provide you in retirement. And finally, stress test it. Could you survive a 30% crash early in your retirement? Or could you cut your spending by 15% if required? Feel free to pause the video at this point and do the math yourself. Done? Good. So here's the truth that the media never tells you. Studies that kill the 4% rule usually focus on the worst case scenarios. While the worst case scenario is useful for crisis planning, it's not the baseline reality for everyone. Real life rarely demands worst case scenarios. So instead of asking, is the 4% rule universally applicable? Ask yourself this: what is my personal safe withdrawal rate given your lifestyle, geography, and the flexibility? And that's how these rules can be turned into reality. So yes, the 4% rule is not one size fits all. For some, it may be 3.5%, and for others, it can be well over 5%. The media will keep declaring it dead every time the markets sneeze. But remember, it's not a magic formula. It's just a compass that points you in the right direction. Your enough number isn't about keeping up with anyone else. It's the number that helps you and gives you the satisfaction that you can sleep well at night. So if you like, my friends, next week we'll dive into how exactly to build that flexible retirement portfolio that adapts to market chaos. So until then, let's not let fear headlines guide our retirement planning, but let the facts and values lead the way. If this helped clarify your retirement planning, hit that like button and share it with someone who's already trying to figure out what their enough number is. And also share with me, what is your take? Are you on team 4% or are you on team flexibility? Let me know in the comments. So until next time, my friends, keep building your freedom.